Coming up, attacks on the Gulf affecting shipping routes and oil. We take a look at what the Reserve Bank will do with interest rates next year and the opportunities for investors in 2024. That is next. It is your daily 10-minute business and finance news wrap for this Tuesday, the 19th of December, 2024. On market day, we will speak with Catherine Allfrey from WaveStone Capital about the opportunities for investors in 2024. But first, to the Reserve Bank, which said it considered an interest rate hike at its last board meeting. So for more about what else it said in its board meeting minutes, which were released today, I spoke with Shane Oliver, the chief economist at AMP.
Look, there was no surprises that the Reserve Bank considered hiking yet again because it remains concerned that inflation's too high. But there was three reasons why it decided to hold. The one is that the economic data released since the last meeting didn't justify a material change to their outlook. Secondly, they seem to be more concerned about the risk of higher unemployment. And they also make reference to the faster decline in inflation globally and the hope that that will flow through to Australia as well. So they seem to have good reason to leave rates on hold, which I thought all made sense.
So it's still open to a rate rise in the future, though, but says it's data dependent. It's an obvious question, but what kind of data?
Well, basically, the RBA is going to be looking at what happens internationally. So they refer to the global economy and developments therein. But in Australia, they're referring to things like domestic demand. The key data piece there, of course, is retail sales, and we get two releases on that front prior to the next meeting. They also refer to the labour market, and we get another jobs report prior to the next meeting. And finally, they also refer to inflation. So they're going to be looking at the next two monthly inflation releases prior to their meeting in February. So it's basically, in terms of Australia, it's domestic demand, retail sales, particularly the jobs market, that rising trend in unemployment, and of course, inflation. They want to see those inflation numbers continuing to fall.
This was the first meeting since the RBA's new agreement with the government, its statement on conduct. I've seen some interesting commentary today saying that members noted that forecasts show inflation returning to the top of the target band by the end of 2025 rather than the midpoint of the band. This midpoint concept is quite interesting because we haven't heard it from the RBA in quite some time, yet the new agreement with the government shows that they don't necessarily want inflation just to be within the 2 to 3% target band, but also to reach this new midpoint. So how significant is this particular statement and what are the implications?
Look, on the one hand, that statement is quite significant. It is the Reserve Bank acknowledging the change that occurred in the new agreement with the government, that over time they target the midpoint of the statement rather than the 2 to 3% range. Now, on its own, that can be seen as hawkish. In other words, inclining the RBA to raise interest rates more than would otherwise be the case, because they're only forecasting inflation to get to the top of the range by the end of 2025, not back to the midpoint. The flip side, though, is that it is going down. And so presumably for 2026, they would have it getting back to the midpoint. And secondly, if you read the statement with the government, the new agreement, it actually says that it should be balanced with progress in terms of full employment. So my suspicion is that the Reserve Bank will not push harder to get to the midpoint now, but will say, well, if we do that, we'll just end up with higher unemployment. So it's a bit of a balancing act, trading off getting inflation down faster versus not causing the economy to collapse. So I think that's the way they're going.
So in saying that, you're of the view that rates will start to fall from mid next year. Why?
Well, we think that inflation will come down faster than the government's allowing for. In fact, we have a view that's more in line with the Federal Treasury view that sees inflation coming down a little bit faster than the RBA is looking at. If you look at the most recent monthly number that came out for October, it was quite a bit less than expected. It's now below 5%. And don't forget that there was very, very high numbers at the end of last year, that surge in travel costs. Those monthly and quarterly numbers will drop out. So it's quite conceivable by the end of this year, when the numbers come out in January, that we'll have inflation down at 3 point something. I'm talking here about the end of 2023. So as we go through 2024, we think we're going to get inflation down to 3%, a bit below what the RBA is saying, coming down faster than what they're forecasting as the weakness in the economy hits. And the Reserve Bank doesn't have to see inflation fall all the way back to the target before they ease, just as long as they can see that it's heading in that direction faster, and also that the monthly and the quarterly sequential numbers are consistent with that lower inflation profile.
What's your message to borrowers if the discussion's now going to be turning into potential rate cuts, right? I know anecdotally, and even amongst people that I know, everyone's starting to say, great, we're going to start seeing some rate cuts in the new year. But are we going to see rates fall as fast as they rose, or are they still going to stay at these relatively high levels for longer?
Look, my message to borrowers here would be that you don't get too excited. Rates are going to come down. That's going to provide some relief. But we saw 13 rate hikes, pushing the cash rate up by 425 basis points, pushing mortgage rates up from, you could have got rates down around 2%. Now you're paying something like 7%. Only a portion of that is going to be reversed. It's going to be a slow and gradual decline through 2024. We see 3 rate cuts, but that just reverses the last 3 rate hikes. Rates are still going to be pretty high. They're going to be way above that near zero cash rate that we had through the pandemic, and mortgage rates aren't going to go back to 2% anytime soon. So yes, we'll get some relief there, but it's not going to be a green light for another borrowing party again. I think it's still going to be a lot tougher out there. Rates are still going to be pretty high.
That is the Chief Economist at AMP, Shane Oliver.
Now, Market Day on the SBS On The Money podcast.
The Australian share market had a really good day today. The S&P ASX 200 up 0.8% to 7,489. For more, I spoke with Catherine Allfrey, Portfolio Manager at WaveStone Capital.
I think if you look back last week in terms of the Federal Reserve and what they said, and I think at the moment we're seeing a tug of war between the market wanting to get to the end game of where rate cuts are for next year. And there's an old adage in markets, which is don't fight the Fed. And the Fed is cutting in 24, and the market thinks it's going to cut about 140 basis points, which is really positive, obviously, for markets. And so the market's trying to price that in already, and has rate cuts starting in March.
That's the US. What about here? I know we heard from the RBA today. Its minutes were released. It said that there's still the potential for a rate rise if the data warrants it, but it seemed like the market is pricing in some rate cuts. Can you tell me more about the divergence between US and Australian interest rates and how that's flowing through to investors?
Sure, from an equities perspective, not a bond person, but you can see in terms of the US, they're pricing cuts from March, which of course some of the Federal Reserve speakers are saying too early. But we do have a US election that they have to consider as well in terms of timing. You don't want to be looking too political, cutting rates right into the election. But here in Australia, the market is currently pricing one for June and another one by December. So around 50 basis points of rate cuts, which I'm sure for mortgage ease out there, they'd be well and truly happy to see that come through. But there is clearly a differential because our inflation is higher and we have a target band of 2 to 3%. So we need to see what the data is like in January before we see the decision from the Reserve Bank in February as to whether or not they'll go again or not.
I guess there's also geopolitical tensions that play on the minds of investors as well at the moment. Oil prices jumping more than 2% overnight following attacks on ships on the Red Sea. I understand BP now says it's temporarily pausing transit ships there. To what extent do you think this could really disrupt supply? And is it something that's concerning investors?
Well, it is concerning because obviously the oil price went up overnight on the back of the news. The Red Sea accounts for something like 7 million barrels per day of oil. And so if there is obviously a delay in that being received by customers, that has an implication on long-term pricing for oil. And so that's what we're seeing priced in. But it's never a good sign when you get those terrorist attacks occurring because obviously it makes suppliers very uneasy. But having said that, the oil price has dropped $20, $25 over the last few months. And so clearly, may have found a base here because we still obviously have issues in the Middle East, issues in the Ukraine, and so and we're going into winter. We just don't know what is going to happen.
If we can target one particular sector on the market today, lithium. I ask because Gina Reinhardt has teamed up to launch a $1.7 billion bid to Explorer Azure. She also, a few months ago, effectively blocked the takeover of Liontown Resources. Is the interest in lithium at the moment justified? And it also comes at a time when there's also a bit of a boom in uranium, which is another sort of like green resource, right?
Yeah. So in terms of lithium, I heard Gina speak last week when she won that AFR Business Award, and her point was having a dig at the Commonwealth and the state governments that to get a mine up from a tenement to actual first production will take way too long in this country, right? And so the easiest way for her to get involved in the sector is to buy into these junior explorers. And they've already done the hard yards. And so that is how she's fast-tracking her entry into lithium. We've seen a massive reduction in lithium prices. It's fallen 60%. It really is dependent, firstly, on the Chinese EV market and the demand for EVs in China. And there's been a few hiccups there, weakness in the economy, etc. But you would think in 24, with more stimulus expected by the Chinese government, that sector over the long term will be fine. Yes, it's had a very difficult 2023, but I think there are, signs that in 24 we'll see stabilisation and it should improve.
This is likely to be the last time I speak to you this year, so I'm keen for you to look into your crystal ball if you can. Where do you see the opportunities for investors in 2024?
Well, it's interesting because I think we could be in for a nice, continue to see this Christmas Santa rally that we've had. And then we might get a reality check in February, because there's no doubt when we go and speak to corporates right now, they're starting to cut in terms of labour. They are seeing a slowing in retail sales post Black Friday. And so these aren't particularly good signs for earnings when they report in February. So I think, back to what I was saying previously, don't fight the Fed in terms of, interest rate cuts. And clearly, markets always look 12 months ahead. And so they see this sort of positivity stimulus coming through. And so they want to buy that. But then going, forward in February, we will get a reality check on earnings. And the question is, do we avoid a downturn? I think we will, and that's what the market clearly has priced. We're in a slowdown, not a downturn. And so for us, in terms of stocks that we're looking at some of the losers of 23, like CSL hasn't performed particularly well. They have some good news coming out of the March quarter, hopefully around their heart drug, 112. And so that should give the stock a nice positive stimulus if that comes through. Macquarie Group is another one of the big cap names that's really underperformed this year, and we think is well set up now that interest rates are being cut, and we'll start getting some more deal making occurring for them, so that will be positive for them. And then there's some of the sort of smaller names that we still like that have performed well this year, but we still think have good outlooks and things like car sales and also Xero. But then some of the down and dirty smaller cap names we've been buying as well. We've bought ARB, we've in Charter Hall. Some of these names, we think is well set up for 24.
Catherine Allfrey there from WaveStone Capital. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.